Welcome to The Explainer. Today, we're going to break down a financial strategy that sounds like it completely breaks the laws of math. It's called the infinite return. This is a really powerful idea that turns so much conventional wisdom on its head, and we're going to walk through the entire blueprint step by step. All right, let's get into it.
So first things first, what in the world is an infinite return? Well, it's not about an investment that goes up in value forever and ever. It's actually about a very specific moment in time. It's the moment you get your initial investment, your original cash, back in your pocket. From that point on, you still own the asset, it's still making you money, but, and this is the key, you have zero of your own money at risk anymore. Your return is, well, literally infinite, because you're getting something for nothing. I know. It sounds like a total fantasy, right? Something out of a get-rich-quick scheme. But it is a very real, repeatable strategy. The catch? To really get it, you have to be willing to unlearn almost everything you've been told about money. You know, the advice that says, avoid all debt, save your money, and just hope for the best with your retirement accounts. This blueprint, it requires a totally different mindset. To build that new mindset, we have to start with the huge difference between two opposing ways of investing. And this isn't just about a minor style difference. We're talking about playing a completely different game with a different rule book.
Okay, so on the left, you've got what most people do. Investing for capital gains. The goal is simple, right? Buy low, sell high. But the method is basically speculation. You're just betting the price will go up. Your focus is on your net worth. But the most important part is your control. It's practically zero. You're just hoping the market goes your way. Now, on the right, you have investing for cash flow. The goal here isn't to sell. It's to have the asset generate regular, predictable income. The method? Building a system, like a rental property or a business that puts money in your pocket month after month. Here, your focus is on your income stream, and your control is high. You control the system.
And the source material from investor Robert Kiyosaki really puts it bluntly. The second you base your strategy on the phrase, "I think it will go up in value," you're not investing anymore. You're speculating. You're not in control. You're just a gambler sitting at the market's casino table. This distinction is the absolute foundation for everything we're about to talk about.
So we've established that our focus is on building systems we can control. But why is this so critical, especially right now? The answer is in the bigger economic picture, which makes this infinite return strategy not just a clever idea, but almost a necessity for building wealth today.
It really starts with how money gets made these days. You hear about things like quantitative easing, or QE. That's just a fancy term for central banks pumping brand new money into the economy. They create trillions of dollars literally out of thin air. It's a stated policy, but it has this huge, unavoidable side effect.
And this is the part that is so crucial to understand. Just creating more dollars doesn't create more stuff. It doesn't build more houses, it doesn't invent new phones, it doesn't grow more food. The total amount of actual value, the size of the whole economic pie, it stays exactly the same.
There's this fantastic analogy that just makes it all click. Imagine the entire economy is one big pizza. Printing more money doesn't make the pizza bigger. All it does is cut it into more and more slices. So what happens? Each individual slice, each dollar, gets smaller and is worth less. That right there is inflation. And it means your money, if it's just sitting there, is losing value every single day.
This brings us to this concept called the velocity of money. Just think of it like the heartbeat of the economy. It measures how fast a dollar gets spent and passed from one person to the next. When the economy is booming, velocity is high. When people are scared and holding on to their cash, money stops moving and velocity just tanks. And the sources point out we are at historically low levels of money velocity. Money is barely moving.
So let's put it all together. You've got two huge forces working against you. A money supply that's constantly expanding, which makes every dollar worth less, and a super slow velocity of money. It means that cash in a savings account is not safe. It's a guaranteed losing position. The only way to win this game is to increase the velocity of your own money. You have to get it out there, put it to work in an asset, get it back, and then do it again, faster than inflation can eat it away.
Okay, so that brings us to the tool that lets you create that velocity. And it's probably the most feared and misunderstood word in finance, debt. But in this blueprint, it's not something to be afraid of. It's an accelerator. It's your secret weapon.
This slide just reframes the whole conversation. We're taught that all debt is bad, but the sources draw a really clear line in the sand. On one side, you have bad debt.
This is what most people use it for, to buy liabilities, things that take money out of your pocket, like a fancy car or a new TV. It makes your cash flow weaker. But on the other side, there's good debt. This is what the wealthy use. They borrow money to buy assets, things that put money into their pocket. It makes their cash flow stronger. Think about it. Apple doesn't issue billions in bonds because it's broke. It does it to grow even faster.
So how does this actually work? Well, it's a pretty simple 4-step playbook. 1. Find an asset that makes more money than it costs to run. 2. Use good debt, what we call other people's money, to buy it. 3. And this is the magic part, the income from the asset itself pays for the loan. And 4. You control the asset and you get to keep the profit every month. The asset literally pays for itself.
Okay, so we have the philosophy down. Cash flow, not capital gains. We get the urgency, the velocity of money. And we have our tool, good debt. Now, let's put all the pieces together and look at the actual blueprints for how to get an infinite return.
The source material has this great, simple story to explain it. Imagine a suit costs $1,000, but it's super rare, so its market value is actually $5,000. A rich guy really wants it. Now, instead of you buying the suit, you go to the store and put it on layaway for $0 down. You now have a contract that gives you the right to buy that suit for $1,000. You don't own the suit, but you control it. Then you go to the rich guy and you sell him your contract, your piece of paper, for $4,000. He's thrilled. He gives you $4,000, then takes the contract to the store and buys the $5,000 suit for only $1,000. You just made $4,000 without ever owning or even touching the suit.
So let's do the math. What was your return on investment? Well, your profit was $4,000, and your initial investment was 0. In math, anything divided by 0 is, well, undefined or infinite. You just got an infinite return. You made money out of thin air by using control instead of your own capital.
Okay, now for a more real-world example. Real estate. Let's say you buy a rental property with a loan, putting just a small down payment of your own money. The rent you collect from the tenant covers the mortgage, the taxes, the insurance, everything. And it still leaves you with a little extra cash flow each month. You just bank that cash flow. After, say, 3 years, the total cash you've collected equals your original down payment. That right there, that is the moment you've achieved an infinite return. You have all of your original money back, and from that day forward, you own a free asset that someone else is paying off for you while it sends you cash every single month.
And this quote just nails the mindset shift you have to make. See, the amateur investor always asks, how much money can I make? But the sophisticated investor, the one playing this infinite return game, asks a totally different question. How fast do I get my money back? They know that once their capital is returned, their risk drops to 0, their return becomes infinite, and now that money is free to go out and do it all over again on the next asset. That's velocity.
So what's the big takeaway here? It's that building wealth might not be about saving for 40 years or trying to pick the next hot stock. According to this blueprint, it's about understanding that there are completely different sets of financial rules and then choosing which game you actually want to play.
Let's just quickly recap the core principles. Number 1, focus on building systems that produce cash, not just hoping for a price increase. 2, get it in your head that money sitting still is losing power. 3, learn the difference between bad debt that hurts you and good debt that helps you and use it as a tool. 4, your main goal is the speed of your money, how fast you can get it back to put it to work again. And 5, your whole objective is to buy assets that pay for themselves with other people's money.
The path we're all taught is to save money, stay out of debt, and just cross our fingers that our retirement accounts go up. This blueprint we've just gone through, it lays out a completely different set of rules. A game played with cash flow, speed, and good debt. It isn't about right or wrong. It's just about knowing how the game is played. So the only real question left is, which one are you going to choose?